Welcome to the Deep Dive. Today we're cutting through the noise of the Q3 earnings season, focusing on a really key sector, heavy trucks and construction equipment. Our mission, as always, is to give you the rapid, expert summary of a pretty complex earnings call. This one happened October 17th, right during market hours. We're looking at a major global player here, and the call was led by their CEO and CFO. And well, the story they told had this fascinating internal split, didn't it?
It really did. That's the perfect way to put it. Internally, you heard management pointing to, quite a few wins, things like cost control, holding on to decent margins, great results from services, but none of that seemed to matter much to the market. The external picture just completely took over.
Right.
Yeah, specifically the slump in North American truck demand, which seems to be getting worse, and this growing headache with global tariffs. Those two things just overshadowed everything else.
And led to that big stock drop. What was it, 8%?
Exactly. An 8% hit right after the numbers came out. The external headwinds they just crushed the internal resilience narrative.
Okay, let's ground this conversation in the actual numbers. Q3 revenue, SEK 110.7 billion.
Yeah.
Sounds huge.
Uh-huh.
But it was down 5% compared to last year. Now, was that purely volumes or did currency play a part for listeners not glued to FX charts?
Yeah, good question. That 5% drop is a bit misleading on its own. If you adjust for foreign exchange effects, FX adjusted, as they say, the top line was actually up 1% year over year.
Right.
So the underlying business, volume, and price mix was basically stable, maybe slightly up, but the currency translation really pulled that reported number down.
Got it. But the earnings, the GAAP EPS, that took a real hit regardless.
Oh, absolutely. No hiding that. GAAP earnings per share fell to SEK 3.71. That's a significant drop from SEK 4.93 in the same quarter last year.
Right. And the number the street really watches, the operating margin. Let's dig into that one.
Okay, so the adjusted operating income, or OI, came in at SEK 11.7 billion. That translates to a 10.6% margin.
10.6%. Now, how did that stack up against expectations?
Well, here's the paradox. That 10.6%, it actually met the LSEG consensus forecast. So on paper, they hit the profit target analysts were looking for.
They hit the target.
But, and it's big, but it was still a 17% drop in operating income compared to last year's 12.0% margin. So meeting consensus wasn't exactly a celebration. That downward trend, that sequential pressure, that definitely worried people.
Okay, but if they met the profit forecast, why the massive sell-off? You mentioned cash flow earlier. Was that the trigger? I mean, hitting OI consensus sounds like they made money.
They did report profit, yes, but profit isn't always cash in the door immediately. If the OI number was maybe a small sigh of relief, the next figure was, like an anvil dropping.
Which was?
Industrial operations operating cash flow. It swung violently negative, minus SEK 1.7 billion.
Minus 1.7 billion.
Yeah. Wow. Compare that to positive SEK 3.1 billion they reported last year. It's a huge reversal. Basically, negative cash flow like that signals financial tightening. Either they're paying bills much faster, or maybe customers are stretching out payments, which ties up working capital.
It just screamed caution to the market, confirming that even with that okay-ish margin, the underlying business cycle is getting tougher.
Cash is king, right. And the cash flow wasn't there.
Okay, let's circle back to that operating income figure. The reported OI was actually higher, SEK 12.5 billion at 11.3% margin. But they adjusted it down by excluding an SEK 811 million gain.
That's right.
It was from selling their SDLG stake. Now, hold on. Why exclude a positive number? Wouldn't you want to report the higher figure? Sounds like managing expectations downwards.
It might seem counterintuitive, yeah. But excluding significant one-off gains like an asset sale is actually pretty standard for complex industrials aiming for transparency.
How so?
Well, management framed the SDLG divestment as strategic part of focusing their capital, but it's not part of the ongoing operational earnings from making and selling trucks or equipment day to day. So the adjusted OI, the lower number, is meant to show you how the core repeatable business performed without that one-time boost. It's supposed to give a clearer view of underlying performance, even if it looks less impressive initially.
Okay, that makes sense. A clearer, if less flattering picture.
Yep.
Now, those external headwinds you flagged, tariffs. If the freight market is hitting volume, tariffs are hitting the margin directly. How bad was it in Q3?
Tariffs are becoming a really nasty and unfortunately predictable drag. In Q3, the net impact was about minus 500 million Swedish krona. So Namish SEK 0.5 billion.
500 million drag. Okay.
But here's the critical part, the guidance. Management explicitly said they expect that drag to nearly double in Q4.
Double?
Yeah, jumping to approximately minus SEK 1 billion.
Ouch. That's a billion krona hit straight to the bottom line in one quarter.
Exactly. And they gave some color on that. Most of the Q3 hit was actually in construction equipment, not trucks. But the key warning was that some temporary mitigation factors they benefited from in Q3, things related to inventory flow, those are gone in Q4.
So no cushion left.
Pretty much. It leaves them relying almost entirely on pricing to offset that billion krona hit. And in this weakening demand environment, especially in North America, well, that's a tough ask. Pricing power is limited.
So if volumes are looking soft, particularly in North America, and tariffs are set to double their hit on margins, where's the good news? What's holding things up? It sounds like the service business is doing all the heavy lifting.
The service business was definitely the star of the show in this report. It really deserves the spotlight. Service sales grew 4%, adjusted for currency.
Solid.
Very solid. It's a structural buffer against the cyclical swings in new truck sales. It shows customers are using the trucks they already have, which means parts, maintenance, repairs.
And that's high margin business usually.
Typically, yes. And get this, service revenue now makes up 28% of their total quarterly revenue.
28%? That's huge.
It's a massive stabilizer. That installed base of vehicles out there is a real asset.
Okay, so service is strong. How did that compare with the actual, selling new units businesses?
It was really a tale of two continents for trucks. Overall, truck net sales were down 2% FX adjusted. But that decline was entirely driven by major weakness in North America.
Okay.
That weakness completely wiped out the continued strength they're seeing in Europe. Europe actually had good pricing discipline and solid demand. It's kind of holding the fort right now.
And what about their other divisions, like the engine business?
Volvo Penta, the specialized engine unit. They actually had a record Q3.
A record in this environment?
Yep. Helped by really strong service penetration in their industrial segments, and interestingly, boosted by growth in things like power generation, especially for the data center market.
So the AI boom is helping sell industrial engines?
It appears so, yeah. Powering all those servers, it's a nice little tailwind for them.
And financial services. Usually when the economy softens, you start seeing some stress there. Delinquencies, write-offs.
VFS, their finance arm, still put up solid earnings, over $1 billion SEK in adjusted OI. But you're right. Management did acknowledge seeing some increase in delinquencies and write-offs in certain areas.
How bad is it?
They were very careful with their wording, described it as on the normal level at this point of the cycle. So it's a yellow flag, maybe not a red one. Suggests they've been proactive with credit standards, but it's definitely something to watch.
Okay, let's pivot to what seems like the absolute biggest driver of that negative market reaction. North America, the heavy truck market there. The guidance cuts sounded pretty severe.
Yeah, this is where the sort of longer-term concern really starts to bite. Management cut the 2025 forecast for North American heavy truck deliveries pretty sharply, down to about 265,000 units.
That's down from what previous forecast?
They were at 275,000, so a 10,000 unit cut for the current year. That confirms the downturn is deeper than they thought just 3 months ago.
And looking further out.
That's where it gets even more cautious. Their first look at 2026, the preliminary forecast for North American retail sales, is only 250,000 units, and they attached an elevated risk warning to even that number.
Elevated risk.
Yeah. It signals that the freight slump, combined with the tariff uncertainty, is really hitting order books hard, and there's an internal factor compounding the pressure, too.
Which is?
They're in the middle of ramping up production for their brand new truck ranges in North America, the new Volvo VNL and the Mack Pioneer. Big, important product launches.
Right, new models. That should be good long-term.
Long-term, yes.
Yeah.
But short-term, it's causing what they call under-absorption costs.
Okay, under-absorption. That sounds like classic analyst jargon. Break that down for us. What does it actually mean on the factory floor?
Yeah, it is jargon. Basically, it means inefficiency costs during a slowdown. They've invested money, retooled the plants for these advanced new trucks, but they aren't selling enough of them yet to cover the high fixed costs of running those modernized factories at full tilt.
Got it. So the factory is ready for higher volumes.
Exactly, ready for the future recovery. But right now, demand is low, so those fixed costs per truck produced go way up. It squeezes the profit margin on each truck they do sell.
Okay, that makes perfect sense. So you've got external volume pressure from the market, you've got internal cost pressure from the new truck ramp up, and you've got tariffs hitting margins. All at once.
A bit of a perfect storm, yeah.
Where is the stability then? Is Europe the only bright spot?
Europe is definitely the main anchor right now. That heavy truck forecast, 290,000 units for 2025, completely unchanged. Steady replacement demand there.
And order books look okay.
Pretty good. Their Q3 European truck book-to-bill ratio was 91%, so orders nearly matching deliveries. And they're being really disciplined elsewhere, too.
How so?
Management explicitly said they are restricting order slots, basically, turning down some orders in places like Asia and South America.
Turning down orders what?
To avoid building up unwanted inventory if those markets soften further, the book-to-bill in Asia was only 48%, South America just 33%. They're prioritizing cash flow and balance sheet health over just chasing volume right now. Very deliberate move.
That discipline sounds sensible, if painful. Let's talk strategy. You mentioned tariffs like Section 232 hanging over them. How are they positioning themselves against those kinds of trade risks? I saw mention of Mexico.
Right, Section 232. That refers to potential U.S. tariffs imposed on national security grounds. For a global manufacturer shipping big, expensive trucks into the U.S., that's a massive, unpredictable threat. It could mean huge duties on trucks built outside North America.
Hence the need to make things closer.
Exactly. It forces regionalization. And that's why the investment they highlighted in Mexico is so strategically interesting. They're building out new structural landing capacity there.
Landing capacity, what does that mean?
Think of it as flexible final assembly or modification capacity within the North American Free Trade Zone, starting at 10,000 units a year, designed to serve both North and South America.
So it's a hedge.
Precisely. It gives them options. If heavy tariffs suddenly hit trucks imported from, say, Europe or Asia into the U.S., they have this capacity inside the USMCA trade bloc, closer to the customer, insulated from that specific risk. It's about building supply chain resilience against political shifts.
Okay, let's tie it all together for someone trying to understand the market reaction. The core puzzle. Why the 8% stock drop when adjusted OI actually met the consensus number.
Yeah, it baffled some people initially, but the market looked straight past that backward-looking consensus beat. It focused entirely on the forward guidance and the negative trend.
So point one.
The lowered 2025 North America forecast. That confirmed the cycle is worse than expected, pushing out any hope of a quick recovery.
Point two.
That doubling tariff drag in Q4, going from $500 million to a full $1 billion SEK hit. That's a predictable, almost guaranteed margin squeeze coming next quarter. Management basically told you it's coming.
Okay. And third.
Just the overall picture into 2026. Weak volume guidance means they have to rely almost entirely on cutting costs just to defend margins. And relying heavily on cost cuts adds a lot of execution risk to the earnings outlook. The market hates that kind of uncertainty.
So if you're holding this stock, or thinking about it, what are the key things you need to watch for the coming months? What are the near-term catalysts?
Number one, without a doubt, U.S. freight rates. Until trucking companies see better rates, they won't have the confidence or cash flow to order lots of new trucks. That needs to stabilize, ideally improve.
Makes sense.
Number two, tariffs. We need clarity on the actual Q4 impact. Does it really hit that full $1 billion SEK? And crucially, any news or non-news on Section 232, that uncertainty needs to lift.
And internally?
The ramp-up of those new trucks, the Mack Pioneer and Volvo VNL, how smoothly does that go? Can they get those under-absorption costs under control? Management is really betting that these new, more efficient trucks position them perfectly for when the replacement cycle does eventually kick in, likely in 2026. They're taking pain now for market share later. Okay, now for our regular segment. And remember, this is absolutely not financial advice. We're just analyzing the information from the call, maybe spitting out a thought experiment like a hedge fund analyst might.
Got the disclaimer. Go ahead.
So the market is freaking out about the cyclical North America volume story. But looking deeper, the immediate pain feels quite specific and then importantly, predictable. So the trade idea. Think about a short-term pair trade. You're essentially betting against the known headwinds while simultaneously backing the company's most reliable cash generator.
Okay, how would that work?
The action. You'd notionally short the group's main equity, betting against the factors dragging it down short-term. Then you'd use those theoretical proceeds to go long, something that represents the value of their installed base, their service business. Maybe not a direct trade, but conceptually.
So along the service business proxy.
Right. The rationale. We know the Q4 tariff drag is coming roughly SEK 1 billion. That's pretty much baked in. We know they have those under-absorption costs from the NA plant ramp-up. Management has basically signposted near-term margin pressure. But at the same time, That service business, it keeps delivering, grew 4% FX adjusted, now 28% of revenue. It's resilient. So the trade idea is betting against the near-term predictable negatives, tariffs, volume softness, ramp costs, while staying exposed to the durable, high-margin service franchise. That service part will absolutely benefit when the big fleet renewal eventually hits in 2026.
So betting against the short-term noise in favor of the long-term structural monetization.
Exactly.
Yeah.
Short the operational friction, long the installed base cash flow. Again, just a hypothetical construct based on the call's data points.
That's a really interesting way to frame the internal tensions they're managing. So let's recap the essentials for everyone listening. The group delivered a surprisingly resilient 10.6% adjusted operating margin, mainly thanks to strong cost control and that excellent service business performance.
Right.
However, overwhelming caution is the theme, driven by that significant downgrade to the 2025 North America truck forecast and that looming, very large Q4 tariff impact that's set to double.
Yeah, caution is definitely the word. And maybe the final provocative thought to leave you with is this. Look at the actions they're taking now. Really tight cost control, deliberately slowing production, even turning down orders in some markets to manage inventory. Are they strategically choosing to accept lower margins today? Are they sacrificing some near-term profitability to ensure they have the leanest operation, the best cost structure, and the most modern products ready to absolutely maximize their leverage when that big North American replacement cycle finally kicks into high gear in 2026?
Trading pain now for gain later.
Potentially. It's a calculated gamble between weathering this current storm and setting up for future market leadership. Something to mull over.
Indeed. And one last time. The opinions expressed here, especially in that trade idea segment, are purely based on analyzing the earnings call data. They are for informational purposes only. This is not and should never be taken as financial advice. Please do your own research. For all the data points and more deep dives, you know where to find us. Thanks for joining the deep dive.